Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, did you ever watch the show Mythbusters? It ran from 2003 to 2016, and I gotta admit, I love that show. The delightfully nerdy Adam Savage and Jamie Hyneman used science to test rumors and myths. Sometimes they would do scenes from movies, old adages or maybe conventional wisdom. They would do internet videos, news stories, and basically try to determine whether or not what was understood as the conventional wisdom or what was shown on the video, was it real? Could it have actually happened in real life? And sometimes the results that they came up with were pretty predictable. But I'm not going to lie, more than once, I found myself surprised by the results of some of their experiments. There were things that I believed that turned out they were myths. And, the reality is there's a lot of things that people believe, and sometimes things that seem very plausible that are actually complete myths. So I thought I would do something a little bit different today. I'm going to be traveling next week, and I'm actually going to be out in Idaho at the Money Metals offices. I get to see the giant vault for the first time. I'm pretty excited about that. We have the biggest vault east or west of New York. It's bigger than Fort Knox, and so I'm excited to get to go out there and see that. But in order to do this trip, I thought it would be easier to go ahead and record the podcast early. And, if you're recording a podcast 3 or 4 days early and you do a lot of current event kind of stuff, things can get stale. So I thought, well, this is something a little bit different I can do. So I thought I would put on my nerd hat and debunk 6 myths that I hear out there that relate to the economy and the financial markets. So before we dig into the myths, I do want to thank you so much for listening to this show. And, I say this every week, but I really do appreciate it because there's a lot of stuff out there vying for your time and attention. So I appreciate the fact that you spend a little bit of time with me every week. And you could do me a favor. I'm not asking you to pay me or anything like that, but if you want to help the show, and I'd really appreciate that, you can do so by simply going to wherever you listen, whatever your podcasting platform is, and writing us a good review. Give us those 5-star reviews. When you see the episodes, share the episodes with your friends. Put them on your timeline. Give us those like buttons. Crush that like button. Those kind of things help grow the show and will help it get bigger and better. So if you would be willing to do that, I would say thank you very much. So with that, let's look at these 6 myths, and I just randomly picked these out of the air. These are things that I'm hearing a lot lately. And the first myth is that silver has underperformed. We hear this a lot, and I think really silver is the victim of comparison. Because, you look at gold, it has hit multiple highs over the last 18 months. We've seen record after record after record. And then we have silver, still below its all-time high of around $50 an ounce that was reached back in 2011, and before that in the 1980s. So, kind of when you look at that and you see gold breaking these price records, and gold is just booming and silver is still below its all-time high, it's understandable that you get this impression that silver's not done all that well. But silver has not been a slackard. And this is evident if you look at its performance on its own terms, not comparing it with gold or something else. Silver is up around 40% so far this year. Now, I don't know about you, but I'd take a 40% annual return any day, twice on Sundays, right? And if you go back to the beginning of 2024, silver is actually up over 76%. So, if that's slacking, well, I can't wait to see what silver does when it finally gets its act together, and quits being lazy. But this is actually predictable. Like, if you understand the silver market, if you've watched the silver market over time, this is exactly what you would expect. Silver typically lags gold during a gold bull market. Silver has historically made its move later in the gold bull run. But here's the thing. Silver has also historically outperformed gold in a gold bull market. Now, we haven't seen that yet, but I think we're still very early in this gold bull market, so that kind of makes sense, right? As I talked about on the show last week, and if you haven't listened to last week's show, I really took a deep dive into the silver market, so check that out if you haven't listened to it yet. But I mentioned this last week. We can see this tendency in silver if we chart the gold-silver ratio. And the gold-silver ratio is simply the amount of silver it takes to buy 1 ounce of gold. You're pricing gold in silver. And historically, this ratio has gotten really wide early in a gold's move up. And then later on in the bull run, silver snaps higher to close the ratio back to its historical mean. That historical average for the gold-silver ratio is around 60 to 1 in the modern era. Right now, the ratio is hovering in the high 80s to 1. I think it was 88 to 1 last time I looked. And again, I'm recording this several days before it's going to air, so that could have changed. But we've been in this range, 80 to 1, 90 to 1 for quite a while. So as just one example of how this has played out in the past, go back to the pandemic era. The gold-silver ratio actually set a record in the early days of the pandemic. It got up to 123 to 1. And then it plunged to around 60 to 1 as central banks around the world cranked up the money creation machine to cope with all of the stupid government shutdowns. And as you probably remember, gold did really well during that period. Silver did actually better. From its June 2020 low, silver gained 80% in less than 20 weeks. So a very impressive snapback for silver. We've seen this before, as I mentioned. It's a historical pattern that we can notice in the silver market. So silver really seems to be doing what silver does, calling it a laggard. Really not so much. So there's one myth busted. Myth number 2. I hear people saying, and I think Donald Trump's actually said this, that tariffs could end up paying for the government. And I hear people saying, Trump's going to shut down the IRS, right? We're going to get rid of the IRS. We're not going to need it anymore. We're getting this tariff revenue. That's going to pay for the government. And people get all excited. And I'm telling you what, sounds great to me. I mean, I'm all for getting rid of the IRS. But even a cursory glance at the actual numbers reveals this is an utter fantasy. Okay, here's the reality. Tariff revenues have surged, true, and yet last month, in August, the federal government still ran a $344.79 billion budget deficit. So we've got people talking about funding the government with tariffs. They can't even close the deficit with tariffs. Here's the numbers. The U.S. pulled in $29.5 billion in customs duties in August. That was a staggering 321.4% increase over last August. And we still had the second highest deficit of the year. So teasing out the numbers a little further, through the first 11 months of fiscal 2025, and keep in mind, the fiscal year runs from October through September. So September is actually the last month of the fiscal year. Through the first 11 months of fiscal 2025, the U.S. government brought in $165.2 billion in customs duties. That is up $95.5 billion from the same period in fiscal 2024. Now, keep in mind, we have October, November, and December, which we didn't have the tariffs. That happened later on in Trump's term. So this is a big jump in tariff revenue. It's true. We've seen a lot of money rolling into the Treasury. But think about it. $95.5 billion. That's not really that much in comparison with the whole federal budget. And think about this. Tariff receipts are probably about as close to as high as they're going to get, right? I mean, from what I've been told, this is how it's been spun to me. And I'm going to be upfront. I'm not a big fan of tariffs because they're taxes. They have a whole set of problems of their own. But what I've been told when I've kind of complained about the tariffs is that, hey, Trump has a plan here. The tariffs are really just a tool. They're using the tariffs to get us better trade deals. We're using them as leverage. And that makes sense. I may not agree with it, but that is a viable political strategy. I get that as an idea. Use them as a negotiating a negotiating tool to get better trade deals. Makes sense. But ostensibly, tariff rates are going to fall as the deals are made, right? Because we're doing these punitive tariffs to bring people to the table to get them to negotiate. So when the deals are made, the tariffs are going to go down, right? And on top of that, even if they don't, as markets adjust to these import taxes, people are going to start figuring out ways to avoid the tariffs. That's just normal human behavior. We see this anytime a new tax is levied. The initial revenue collected from taxes typically goes up, but then people try to figure out how to avoid those. They make other contingencies. And that's going to be true of tariffs as well. So they're going to substitute. They're going to find new options. So over time, tariff revenue would probably fall off even more, right? Now, maybe that's going to be balanced out by trade and economic growth. That's a viable argument. But even so, tariffs were less than $30 billion last month. And that was this huge increase. Do you realize how much the federal government spends? The Trump administration blew through $689.1 billion last month alone. Incidentally, that was 2.5% higher than August of 2024. So, if we look at the tariff revenue that was brought in August, and we compare that to the amount of money that was spent by the federal government in August, tariff revenue would need to go up, get this, 2,196% to cover the spending. And people think they're somehow going to use tariffs to fund the government. I mean, I'm just talking about closing the budget deficit, right? Total fantasy. I mean, sure. If they drastically slashed the size and scope of the federal government, it might work. But that's not the plan, right? Here's another factoid. They could cut all of the discretionary spending. I mean, get rid of every department and every program, including defense, and it would only slash the budget around 27%. Discretionary spending is only about 27% of the federal government budget. The vast majority of the spending is on Medicaid, Medicare, Social Security, the so-called entitlements. On top of the fact that we now have over $1 trillion a year that we're spending just on interest on the national debt, right? There's no political will to address any of that. So, no, tariffs are not going to fund the government. Myth number 2, busted. Myth number 3, this is a more specific to the gold market. I hear people sometimes say that owning a gold-backed ETF, that you can buy on basically any exchange, is the same as owning physical gold. Now, should be obvious if you just think about it, right? If you have an ETF investment, you have paper. If you have physical gold, you can touch the gold. You have the physical metal, right? So you don't really own gold when you own an ETF. You own a share of a fund that is purported to be backed by gold. Now, it absolutely does give you exposure in your portfolio to the price of gold. So if you have a gold ETF, it's generally going to move along with the gold price. As the gold price goes up, your ETF is going to go up and vice versa. But it's not the same as having the metal. As you probably heard people say, if you can't touch it and hold it, you don't really own it. Now, I'm not saying that ETFs are a bad thing. I'm not trying to poo-poo them. They have their place in an investment portfolio. I have some shares of gold and silver ETFs. They're a convenient way for investors to play the gold market. They're relatively liquid. You can buy and sell an ETF with a couple of mouse clicks. You don't have to worry about transporting or storing metal. So in a nutshell, it allows investors to play the gold market without buying full ounces of metal at the spot price. It's convenient. And again, it is a way to expose yourself to the price of gold. But you're only buying a number in a computer, right? Even though you can trade your ETF shares for another stock or cash whenever you want, even multiple times in the same day, and it's a great thing for speculative investors. They can take advantage of this liquidity. It's not owning gold, right? It's a convenient way to play the price of gold on the market. You still don't possess any gold. You have paper. I can't emphasize that enough. And the people that are selling you the paper, they're telling you that they have a certain amount of gold to back up their ETF. You don't know that. You can't go look at the gold. right? In a lot of these scenarios where you have a lot of gold that's supposedly moving into ETFs really fast, there have been documented difficulties or delays in obtaining physical metal. So the fact of the matter is you don't know that an ETF actually has the gold that it claims. If you have gold and silver and you're safe at home, you have gold and silver. And even if you store your gold and silver in a place like the Money Metals Vault, you have a much better sense that your gold is there because we guarantee that the gold is segregated. We have audits. You can look at all of the documentation. It's very difficult to know exactly how much gold any ETF actually has. So I've always believed, and this would be the recommendation I would make, even though I should emphasize I'm not an investment advisor, so this is just Mike Maharrey's opinion. But I think investors should get physical gold or physical silver first, and then you can supplement with an ETF, right? Or use your paper gold to trade on the short-term market if that's what you want to do. But you want to have that foundation of physical metal, right? I think one of the reasons that people like ETFs is that the big advantage is you don't have to buy full ounces of gold at one time, right? You can buy a small share of an ETF. You can invest $50 into a gold ETF, right? You're not going to get much for $50 if you're trying to buy physical metal. But did you know that you can build your physical gold and silver holdings over time? Here at Money Metals, we have a monthly program where for as little as $100 a month, you can begin to build your precious metals portfolio. You can buy those partial ounces of gold, and then over time, you're going to build up to ounces and ounces. So I'll link to that in the show notes page. Definitely something worth checking out. It's an option for you to kind of do what you might do with an ETF and build your precious metals portfolio over time. So, myth number 4. Monetary policy is tight right now. No, it's not. At least not from a historical perspective. And the Federal Reserve's own data backs me up when I say this. Now, if you go out and listen to CNBC, Fox Business, the mainstream financial media, you're going to hear them talking about, monetary policy is tight. We've got to loosen it up. It's too tight. Donald Trump will tell you monetary policy is too tight. Jerome Powell has said in his speeches, monetary policy is tight right now, but we're going to loosen it up when the time is right. Monetary policy is not tight, ladies and gentlemen. The Chicago Fed has what is known as the National Financial Conditions Index. And you can go check it out. They have a website for it. And as the Chicago Fed explains, quote, positive values of the NFCI have been historically associated with tighter than average financial conditions, while negative values have been historically associated with looser than average financial conditions. So as of last Friday, the NFCI was negative 0.5. That is a negative value, which has historically been associated with looser than average financial conditions, not tighter. Here's the kicker. The National Financial Conditions Index never went positive, even at the peak of the Fed's tightening cycle, when they took it as high as it went, back in 2023. Never got positive. It got close. It was right on the line. I've got a chart. I'll put it in the show notes page. It never got there, though. So, despite its efforts and a lot of jawboning, the Fed still hasn't pushed monetary policy over the edge too tight, at least not in a historical context. We can also see the fact that that the monetary policy isn't tight with the growth of the money supply. If you have a really tight monetary policy, you're not going to see money supply growing. You'll actually see the money supply contracting, which is the whole point of tight monetary policy, right? You want to contract the money supply. You want to wring the inflation. And remember, inflation is defined as the growth of money and credit. So high inflation means growing money supply, growing credit. Rising prices are a symptom of that monetary inflation, okay? So if we look at the money supply, at the end of July, the M2 was, the M2 had expanded by more than $600 billion since the low point it reached in 2023. And it is above the peak reached during the pandemic. So again, monetary policy is not loose. It did tighten up in the midst of the tightening cycle back in 2023. As I mentioned, the National Financial Conditions Index almost went positive. So it almost, it was probably neutral from a historical standpoint. But we did see a contraction of the money supply in that time. So it was tighter, is what I'm getting at. But it never really got tight. And that's why I've said over and over again on this show, the Federal Reserve never did enough to slay inflation. And, it's interesting. If you go back and look at interest rate history, especially if you go back before 2008, it reveals the same story, right? You can look at a chart that shows the Federal Reserve interest rate history going back in time. You're going to note that there's a general downward ratchet effect in rates. So when when the economy goes shaky, the Fed cuts rates, right? And it cuts rates until it gets low enough and it stimulates the economy. And then they raise rates again as the economy normalizes. So you have this cycle of the rates going up and down. Each time, the Fed has had to take rates lower and do more monetary policy to get the stimulative effect. And then after the fact, the interest rates have gone up, not as high as they were before. So there's almost like this stair step. So each interest rate peak preceding a bust gets lower as the economy is becoming more and more addicted to easy money. So in effect, what I'm saying here, what I'm explaining is the economy needs a bigger dose of easy money to reinflate the bubble each time through the cycle. So the most notable aspect of an interest rate chart is the nearly 10 years of 0% interest rates following the 2008 financial crisis. And you'll see it barely goes up to like 2%, and then it goes back down to zero again for the pandemic. So we had almost 2 decades of historically loose monetary policy. This is the actual outlier, right? That was not the norm. The norm was not 0% interest rates. And yet we now have millions of people who work in the financial sphere who have never experienced a normal interest rate environment during their careers. They imagine that zero is closer to the norm than 5.5%. The fact is 5.5% is slightly below the historical average in the modern era. So the zero is the outlier. Don't forget that. So here's the thing. While monetary policy isn't tight from a historical perspective, and the data bears this out, it is tight in a universe with a massive debt black hole. What does a black hole do? Well, it sucks everything into it, right? It impacts everything around it. And that's exactly what these huge piles of debt are doing in the economy right now. I'm talking about government debt, so like the national debt, which is over $37 trillion. Corporate debt, I've talked about before, we have a huge rise in corporate bankruptcies right now because they're strained by the massive levels of debt. Consumers are buried in debt. They're running up their credit cards, trying to make ends meet. Everybody is levered up to the hilt. And of course, this was incentivized by the years and years of 0% interest rates. This was kind of on purpose, but now it's a problem, right? Because it's inflationary. And by the way, the black hole analogy is not mine. I have to give credit to Greg Weldon. And I'll link to an article in the show notes where he digs into this debt black hole. He does some really good analysis on it, and it's worth your time to give it a read. So that'll be over at moneymetals.com/news. But the long and short of it is that this debt-riddled bubble economy is addicted to easy money. It needs an easy money fix. And even at this moderately tighter level, it's just too high. Even though it's still historically loose, it is too high given the economic conditions. And that's why everybody's desperate for rate cuts. I mean, fair enough. I'm not saying that people are wrong when they're saying that we need an interest rate cut. Given the amount of debt and the fact that the higher interest rates are exacerbating that debt problem, it absolutely makes sense to call for rate cuts. But don't forget that when we cut rates, we're actually talking about cranking up the inflation machine. And as we saw from the August CPI, price inflation is alive and well. So as I've talked about, I've been emphasizing this week after week after week, the Federal Reserve is between a rock and a hard place. It has a catch-22. It simultaneously needs to raise rates and lower rates. I actually thought about doing a show where I make the case for rate cuts and I make the case for rate increases. And I guarantee you, I can make very good, compelling cases for both because both are true, but you can't do both. So what is a central banker to do? Well, I guess we'll have to wait and find out. My guess is they'll do what they always do and pick inflation and try to keep propping up the economy. So that was myth number 4, busted. Let's go to myth number 5. And that is gold is the best performing major asset this year. That's a myth. Now, don't get me wrong. Gold's done great, right? It's done better than stocks. It's certainly done better than bonds. It's outperformed most commodities. It's even outperformed Bitcoin this year, believe it or not. But it is not the best performing precious metal. As I've already alluded to, silver has actually done slightly better this year. And silver isn't number 1 either. The honor goes to platinum. Platinum is up just over 51% since the beginning of the year, and most of that gain has actually occurred since early June. According to the World Platinum Investment Council, the WPIC, global platinum coin and bar investment surged by a staggering 660% in the second quarter. And this was driven by a dramatic 55% increase in platinum coin and bar demand in China. We've also seen a big jump in demand for platinum jewelry. In fact, it hit the highest level since 2015 through the first half of this year. And the main driver behind platinum's compelling price performance is supply constraints. The global platinum market charted its 3rd straight significant structural deficit last year, and we should expect these supply shortfalls to continue into the foreseeable future. It's really kind of similar to the supply and demand dynamics that we've seen for silver. When demand exceeds mine and recycling output, people who need to source the metal, mainly your industrial customers, they have to access above ground stocks held by investors. And of course, to do this, they have to incentivize them to let their metal go. How do you do that? You offer a higher price. So that's what's pushing the price up. These supply shortfalls are doing the same thing in both the platinum and the silver markets. So platinum is actually the best performing precious metal and arguably one of the best performing. I wouldn't call platinum a major asset. Gold is considered a major asset class. So I think it's kind of fair to say that gold is the best performing major asset. But I just wanted to kind of bust the myth up a little bit and point out how well platinum has done. And, you know, it's interesting because platinum used to be more expensive than gold back in the day. And over the last, I think it was since like 2016 or 2017, gold has soared and platinum has dropped. So, I mean, if you ever got back to that price parity, still platinum has a long way to run. So there's a lot of bullish sentiment out there in the platinum market. All right, one more myth to bust. Number 6. And this one's a little bit more nuanced. A lot of people imagine that buying gold jewelry is a good investment. But the fact of the matter is, at least here in the US, it's not necessarily that great because most of the jewelry sold here in the United States is 14 karat or maybe 18 karat. And what that means is it's not very pure. So when you hear something is 14 karat gold, what does that mean? Well, it basically just means that the item is 14 parts pure gold mixed with 10 parts of other metals, less valuable metals. So it's a 24 karat system. So 24 karat gold is pure 100% gold. That means that 22 karat gold would be 22 parts pure gold and 2 parts other metals. So the lower the carat, the lower the purity of the gold. So if you get like 10 karat gold, it's only 50%. It's less than 50%. So the reason that they mix other metals in with gold is that gold is relatively soft in terms of the scope of metals. So when they mix it with other metal, the jewelry is more durable. It's less likely to bend or get scratched up or tarnished. Not tarnished. Gold doesn't tarnish. But it's just stronger, right? But when you go to resell your gold, you don't nearly have as much gold as you think, right? And you may have experienced this. I remember once I wanted to pawn a gold ring. I didn't want to pawn, I wanted to sell it. And I took it in, I thought, I'm going to get, this is how many ounces and blah, blah, blah. They hardly offered me anything because it was 14 karat. It's not very pure gold. So therefore, buying your 14 karat gold chain at the jewelry store is just not really an investment. I'm not saying you shouldn't do it, right? I mean, I'm sure your wife or your significant other is going to appreciate that gold chain very much, but you're not making an investment, right? And don't get me wrong, the value of gold in your piece is going to go up, right? But it's not the same as owning pure gold. And you're paying a premium because it's been formed into jewelry. So you're not going to substitute your gold investment by buying, going out to your local jewelry store and getting some gold chains. Now, here's the nuance I was referring to. In many countries, jewelry is much more pure. In fact, in India, you'll typically find a lot of 22 karat pieces and some things that are even 24 karat pure gold, right? Pure gold chains. In fact, my wife has a pure gold, 24 karat gold bracelet. These are a good investment because they are closer to pure gold, right? It's like owning a gold coin or a gold bar. And that's why a lot of Indian families consider their gold jewelry an investment. So if you are thinking, I'd like to get my wife or my husband or my girlfriend or boyfriend or whatever this gold jewelry, and I want it to be an investment, well, you want to look for at least 22 karat, if not 24 karat gold. That's where you're going to get your investment value. Now, if you're just looking for something that's pretty, that's going to make your girlfriend give you a kiss, then by all means, that 14 karat gold chain is going to work for you, but it's not really an investment per se. Now, we do sell higher purity gold jewelry here at Money Metals over at moneymetals.com. We've got chains, bracelets, rings, pendants, earrings, cufflinks, and more, all formed from 22 to 24 karat gold. So you can check that out over at moneymetals.com. And it's a great gift idea. If you've got a birthday coming up, or actually, Christmas is right around the corner. Great gift idea. So check that out. And, if you want to learn more, give us a call, 800-800-1865. You can talk to a Money Metals precious metal specialist. These folks are fantastic. They can help you figure out how to fit gold and silver into your investment strategy. They can explain how you can hold physical gold and silver in an IRA. They can help you figure out, is it better to get bars or coins? Very knowledgeable people over there at Money Metals. And I highly encourage you to call them today. I talk about this on the show all the time. In this era of devaluing money, when the value and purchasing power of your money is diminishing every single day, when they have a policy to devalue your money 2% every single year, 10% every 5 years, you want to have real money. You want to have gold and silver. So that's why you need to talk to a Money Metals precious metal specialist today. I've mentioned the fact that silver is still at a bargain, at least historically compared to gold. So it might be a good time to get in on the silver investment before we see that leg up, which is potentially in the future. So just do it today. Give them a call. And if you don't like to talk on the phone, okay, don't give them a call. You can go to moneymetals.com and you can actually chat with a precious metals specialist online in a chat. Or, if you want to just check out that beautiful gold jewelry, or if you want to get some gold coins or some silver bars, you can do that right from the website. We'll have them shipped to your home, or we can store them in our state-of-the-art vault, which I mentioned earlier in the show. So do it today, 800-800-1865. So that is a wrap for this myth-busting episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show and a lot more over at moneymetals.com/news. If you want to get the latest news and information relating to gold, silver, precious metals right in your inbox, make sure you sign up and get on our email list. You can join 1 million other people. And of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you can tune into our Market Wrap podcast that runs on Fridays. And if you listen to that show, you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people in the world of gold, silver, economics, and investing. So again, thank you so much for listening to the show. Go out there and crush those like buttons and share the episode. And I hope you've enjoyed the little bit of myth busting. And I'll be back again next Wednesday to chat with you about some more stuff. See ya.